The share price for REITs have been downright horrible. If you see this chart over here, for the last 1 year, it has lost 7.5%. Actually, if not for the recent 8% bounce, the total decline for this 1 year could be 15.5%. It is no wonder that many believe that REITs are a poor investment right now. So what is the main reason? Interest rates, correct? Coming right next, I'll show you evidence why near-term interest rates really impact REITs. Coming right to the very end, I'll also show you the secret to selecting the right REITs. So if you're curious to find out, continue watching. Hi guys, welcome back. Let's address the first key topic: interest rates impact on REITs. This is a commonly raised concern because it's so easy to observe from REITs' share price. The easiest way to confirm the adverse reaction that REITs have when interest rates go up is actually to plot them side by side. This chart shows the US 10-year Treasury rates against CICT, who is Singapore's biggest S-REIT. CICT is Capital Integrated Commercial Trust. It owns offices and it owns popular shopping malls in Singapore like Plaza Singapura and Bugis Junction. You would see that CICT actually rallied at the start of the year when interest rates fell, correct? And in March, when interest rates climbed up again, CICT's share price actually fell. This inverse correlation can be observed again in July 2023 and eventually towards the end of 2023 when interest rates continue to run up high, CICT's share price fell tremendously. But there's something to note. Ever since October, interest rates have cooled off, correct? Again, there's the blue line on top. And what we can observe is CICT's share price actually rallied. CICT is not the only REIT who has rallied in the last 1 month. There are US office REITs who have rallied 50 to 90%, as you can see over here. But I wouldn't suggest touching them because they could be distressed. Instead, I'll show you other REITs who are more fundamentally sound. Ascendus actually rallied 8+%. Keppel DC actually rallied 10+%. So REITs can be volatile, but if you see it as an opportunity, maybe I'd like to introduce you to today's sponsor, who is Moomoo SG. If you'd like to buy Singapore REITs with a simple to use, cost-effective broker, you can actually do so on Moomoo's platform. Moomoo's offering you $0 in commissions free for 1 year, which makes it one of the cheapest platforms to trade Singapore stocks. Right now, they have actually a starter kit that is worth more than $600. If you're keen to invest in your favorite US stocks like Apple and Tesla, you can also do so on Moomoo SG. Now they have a new feature that can allow you to do fractional shares trading. Not just that, if you have spare cash that you're looking to park for extra returns, check out Moomoo Cash Plus. Now it's 5.8% guaranteed for the first 30 days, and you can actually park up to $80,000. So again, recommending you to sign up for Moomoo's trading platform. You'll not only get the Moomoo Cash Plus, you also get fractional shares of the most popular traded US listed companies. In total, this welcome bundle is $680. So again, if you're looking to sign up, look for the links below. Now back to our discussion. The next question for those of you a bit more experienced is, hey, this inverse relation suggests that REITs are a bit like bonds, correct? For those of you who are not too familiar with bonds, bonds are actually an IOU, whereby a fixed return is guaranteed to the investor, and that fixed return cannot change because it is an agreement. So if you have invested into a bond that pays 4%, and right now the market is at 5%, you realize that nobody wants to buy your bond, correct? And therefore the share price needs to drop. The bond will start to trade at a discount. On the converse, if your bond pays 4% still, and now the general market is paying only 2%, your bond is very valuable already, right? And therefore the bond price goes up and is priced at a premium. Bond prices and interest rates move in opposite directions. And it can be confirmed by looking at the price chart for a simple bond ETF. Let's use this, which is the US 7 to 10 year Treasury ETF with a ticker IEF. You would realize in the last 3 years, this ETF price has crashed, correct? Losing a grand total of 22%. I'll next use this to plot against CICT as well as the US 10-year rates. What we can see is CICT in the yellow line trends almost identical as the bond ETF. Take a moment to absorb this and also ask, is this just CICT? Can we compare this observation against other REITs? And can we look at a longer time frame? I've actually done the homework for you, and before I share that, smash the like button because it's taken our team hours to prepare this presentation for you, and hopefully it can help you become a better investor. In this screenshot, I've actually plotted Frasers Centrepoint Trust against US 10-year rates, and I've actually tried to map them on identical timelines. To help you make easy observations, let me draw some lines to point out some events to note. Back in 2013, the blue line, rates fell, correct? And Frasers Centrepoint Trust's share price actually rallied. The inverse happened next. In 2014, rates climbed and the share price actually fell. Then in 2016, in the yellow line, rates dropped a little bit and the share price climbed slightly. Then in 2018, rates rallied a little bit, but the share price for Frasers Centrepoint Trust actually climbed slightly. The yellow lines depict areas whereby the correlation between REIT price and interest rates are not that strong. Then, interest rates once again dropped and the share price for Frasers Centrepoint Trust actually rallied strongly to its peak of around $3. All these events happened before COVID, and after that is where we usually have recency biases. As interest rates climbed in 2022 and 2023, Frasers Centrepoint Trust share price actually started to come down. So it seems in the near term, REITs seem to be impacted by interest rates sometimes, if not majority of the time. This is the obvious, correct? But you're not here for the obvious. And therefore, I'd like to share with you second level thinking in terms of investments. In the near term, interest rates will impact all REITs to a varying degree. But we need to look carefully at business fundamentals. Since we're on Frasers Centrepoint Trust, let's look at some of its details. It currently owns 4 of Singapore's top 10 largest suburban malls. They include Nex, North Point, Causeway Point, and Waterpoint. I'm sure you've been to them and you realize that they are usually very crowded. Recession or not, I'm sure we're all going down to the malls to still spend on food and entertainment. Therefore, rent is actually going up, as you can see in the chart on the right hand side. Frasers Centrepoint Trust owns suburban prime malls, and you would realize that per square foot rent they are collecting has inched up from $30 to $31.45 in a span of 2 years. That's about 5% per square foot increment. CICT owns malls that are usually in city centre, and therefore most of their malls will track closer to the blue line on top. But CICT also has offices, correct, which is a different sector. Therefore, share price is reflecting a different reality. Let's continue to focus to deep dive into Frasers Centrepoint Trust. I'd like to next show you that it has successfully refinanced all its upcoming year's debt to 2029. This is to tell you there's no pressure on refinancing, and Frasers Centrepoint Trust is also one of the few REITs who have actually sold down their assets to deleverage. That is why when we look in terms of REIT analysis, we need to understand their borrowing costs, and the aggregate leverage is very important as of this cycle. Frasers Centrepoint Trust's net borrowing is about 36.1% only, with 63% of its debt actually fixed. Therefore, I think it's very reasonable to expect that its cost of debt will start to flatten off and not climb anymore aggressively. This is one of the key reasons I picked Frasers Centrepoint Trust to cover in my recent Georgetown Finance Summit. Here are some snippets on what you can expect when you purchase access to it. I'd like to ask this question. Are we entering a shrink to drop gearing phase? If you expand, we're going to punish your share price. If you cut down on your gearing, maybe we'll reward you. Are we entering this phase or not? Very interesting to think about. Before I show you what has happened to previous gearing, let me answer this question also. Why are some having such cheap loans? So if you're keen to learn, look for links below. Earn that amounts back very simply by investing well. It'll make a big difference to your investment outcome already. Since you stuck right to the very end, I'd like to round things up nicely to highlight some key investment wisdom. Short-term interest rates do impact all REITs. Some may get killed, but some may actually present you a buying opportunity. This is actually by Benjamin Graham. In the short run, the market is a voting machine, but in the long run, it is a weighing machine. What that means is that in the short term, sentiment of REITs can be sour because of interest rates. But in the long term, if the REIT you pick is having strong business fundamentals, you'll ride out this interest rate trauma and grow and deliver you better dividends per unit along the coming years ahead. Stay invested in such good REITs. Remember the advice? Check out these which are related to this topic, and I'll see you there too. Take care as always. Goodbye.